in today's session of Visual JForex, we are going to go into the details of the Williams percentage R. This is a technical indicator developed by the Bill Williams, and this is the last part of this series in which we have taken into consideration various trading indicators which were developed by the Bill Williams. So far, we have considered the acceleration, deceleration indicator, the alligator indicator, the awesome oscillator, BWMFI, which is the market facilitation index, and fractal. And in yesterday's session, we also uh, took this brief view of Gator, and now it is the turn of the Williams R. Williams R is similar to stochastic, in which you can measure the overbought and oversold situation prevalent in any underlying instrument, and this is an indicator which will help you determine the entry and exit points if you are if you believe in trading in oversold overbought situation, taking contra trades, and in such scenarios this is a useful indicator to work with. And the difference between the stochastic and the Williams percentage R is that here the Williams percentage R has a upside down scale, means all the values which you get as output are in negative territory below zero, and it uh, it gives you also the internal smoothing. We have to provide the input parameters, and then accordingly we will get the output parameters. Here is the block of Williams percentage R on the Visual JForex platform developed by the Dukascopy Bank SA, which can be used to automate our trading system, and then we can give our trading job our you can say we will need not be spending time in front of the screen watching all the ticks, all the price moves. Rather than that, we can define certain conditions, and accordingly the algorithm will execute the trade. And this is the series in which we are trying to get familiarity with various indicators involved, which can help us fulfill this requirement of making the trading system automated, and then we can just sit back and relax and observe the trading being done automatically by the various algorithms which we can develop, and also we can do the prior testing, so that way we will also know what is the probability, what is the profitability of any particular setup on which we are relying to get our trading done. Now here in this block you will get this description, its functions, the technicals, and then we have to define these input parameters as well. We will also see how it appears on the chart. So here the input parameters are four. You have to provide the default instrument. Any instrument on which you want to trade can be taken here. So you can choose any instrument which is supported by the Dukascopy Bank SA, this Visual JForex platform. We have this listing here of all the instruments which are supported. In today's session, we will choose USD JPY. So let me find the USD JPY, and so you have to find any instrument which you want to use in this list, and then select it, and your algorithm will be using that particular instrument. So here we are defining the default instrument as USD JPY. So USD JPY will be the instrument of our choice for this session. Now coming to the time period can be anything between 10 seconds to 1 month, and here we can choose the time period as per our requirement: 1 minute, 5 minutes, 10 minutes, 15 minutes, 30 minutes, and hourly, 4 hourly, daily, weekly, and monthly as well. So let us for example take hourly. You can also do it here. Now it has been created as a temporary variable. You can even fix it. You can kind of you just have to take the time period as per your requirement. So now if we consider on the chart, here we have this chart on which the Williams R has been plotted, and we here change the instrument. So here you can see that Williams R, these values, when the Williams R value was below -80, it was indicative of the fact that the underlying instrument, in this case USD JPY, is in a oversold territory, and it is now, after due consolidation on the lower side, has shown some upward bias and has gained around 10 to 15 pips in last couple of hours after being in this oversold situation. So here the whole purpose of the Williams R is to get us such instances where the underlying instrument has entered into a overbought or oversold territory. That means that lot of price action has been on that side for quite a considerable time, and also the fatigue is coming in whenever we see again the price action, and this value again trying to regain the levels and rise above this -80. So in such instances we can say that after being in oversold scenario, the instrument is finding some buying support on the lower levels, or when it is on higher side, when the underlying instrument has been in an overbought scenario. Whenever the value starts to fall below -20, we can say that now this overbought situation is kind of resolving, and again selling pressure is coming back. So we can use this indicator as a guiding force and as a entry, you can say a determining factor for pinpointing the entry points. So we can use this both ways. Also this value, when it is in between this -20 and -80 level, suppose if the value is falling, then you can consider it as a continuation of the sell trend, and whenever the value is on the rise, you can also consider it as a continuation of the buy trend, and so you can also use this as a trend determining indicator as well, whenever the values are not in extreme territory, but rather the price action is keeping the Williams R's output in between these two extreme levels of overbought and oversold. So in such scenarios, you can use this as a trend determining indicator. Now here, coming to the next parameter, the shift. Shift is the look back period. Suppose if you are using 0, then that means the current hours Williams R value will be taken into account. If you are using shift 1, then the last hours Williams R value output will be taken into consideration. And if the shift is 10, then we will be going back 10 candle period. Suppose now it is defined for 1 hour each, then that means we have to go back in time by 10 candles, and if the time is 6 GMT of 22nd July, then I think it will be 20 GMT of 21st July. So here somewhere this bar will be denoting this Williams R value, and you can use this value even during the current hour just by going back in time and taking into account the value prevalent there, and you can plan your trading setup accordingly. So if we feel that we shouldn't be getting involved during the initial hours of overbought or oversold scenario, then you can put in condition that say 10 hours back it should have been in a oversold situation, only then the buying should happen. So here we will be checking 10 hours back data, and only if the 10 hours back value was in oversold scenario, only then the buying will happen, and vice versa for a sell trade. We can put in the similar kind of condition that 10 hours back the value should have been above this minus 20, and that means it was in a overbought scenario, and now it is ripe for some correction, and we can bet on that. So we can utilize these indicators on any time frame, and go back in time as well as far as the values are concerned. Here this indicator has been defined as per the default time period of 14, but you can make changes to it as well. Suppose if you want to use it on a different, this is default value, you can choose another value if that serves your purpose well. So it's always up to us to define these indicators which are convenient to our setup. So here if we now choose 21, so it will be calculated differently. So here we have this Williams, oops, I think again we have to input has to be on 21. Okay, now as you can see the value, the input has been defined on 21. So here this situation, these values have shifted to some extent, and you have to simply find out the combination as per your requirement, as per your trade setup, and then you can make similar kind of changes in here in this block, and it will be calculated accordingly. Now let us restore it back to the default time period, and here it is. This one also we make the changes back to what it was, and here we are having a formation which is slightly different than the prior formation, as you can notice here. Now the next thing is the output value. Output value have to be considered in the context of two levels, the overbought oversold. In case of any value above minus 20 is considered as overbought, and any value below minus 80 is considered oversold. So you have to do the comparison between various values of the Williams are at different point in time. You can take current value, you can take value say 2 candle periods back, and you can do the comparison, or otherwise you can even choose different setups, and you can use these Williams R block in multiple ways, and there is not much and limit. It's always up to our imagination to what extent we are willing to experiment these with these indicators. And as you might be aware, also the calculation, the absolute value of this Williams R always depends on which side it is being calculated, or bid side, offer side, ask side. It will have slightly different. And then one more key important detail is that on which value, again, if it is closing price, open price, high price, low price, median price, or typical price, or even some other types like weighted close price, time and volume. So how it is calculated also makes a lot of difference. Suppose if we choose volume as the parameter, then you will have different output value. Suppose we choose to edit this and input, calculate from custom data, and here we have side, and so let me see if we can do some changes here. On the chart, we don't have that input parameter listed, but if we choose the volume as the applied price, then whenever there will be average volume, and then whenever the underlying instrument sees too much of a volume for extended period of time, it will be taken as extreme value, and then as per the comparative analysis we will get the normative overbought and oversold areas defined, and then that will be helpful while figuring out when the instrument has entered into any of these extreme zones. And time, as I said, we can't apply these tools on the chart, so because of that constraint I won't be able to explain to you in details, but as you might be aware and as you might be using these calculations make a lot of difference on how these values are calculated. Like low price will have a different output value, and if it is dependent on the high price it will have a different output value. So that's how this indicator works, and this is a extremely useful indicator if you believe in getting involved after the extreme levels have been reached by the indicator. So then this is one of the favorite indicators of many traders. And here also we can't really make change to, and yes, that's about it. So as you can see, even chart has even charting. These many of the tools are not being offered for manual trading, but as you can see here in this automated trading block, we have different applied prices which can be applied for the calculation of the indicator, and then the added advantage will always be there that we don't have to worry about the underlying movement instruments movement day in day out and tick on tick. So that will be the concern of our algorithm, and all we have to do is define and work and make a functional profitable algorithm. So that's it from my side for today's session. I hope that after watching this introduction series, you are getting well familiar with this indicator, and you will be able to use it for figuring out and making your algorithm. We will be back tomorrow in tomorrow's session with a new indicator. Till then, have a fabulous day ahead. See you tomorrow. Goodbye.